Thank you for joining us. We are just running around at lunchtime here. You just woke it up, and I say happy spring, but it feels a little bit more like winter again out there. So again, as always, if you have questions, raise your hand or chat on the chat feature, and we'll get to you as quickly as we can. But other than that, I think I'm just going to go ahead and turn it over to Dave.
Great. Thanks, Jen. We had a good response from what we were thinking before, so we thought, let's just do this again. Let's just talk about what's going on out there. And we all see the news every day, and I just recently, well, this Saturday, talked about the speed of the markets and how fast everything is moving. And so it makes us think that we ought to be doing different things. And it's a good idea just to stop sometimes and recognize that the speed of everything affects everything in our life. And when we look at the markets and we think about how incredibly fast it is, it's hard sometimes to cut through all the babble or even to think we ought to be thinking about long term. There's so many problems in the world. This time feels different because it's such antagonistic, if you will. And it is. There are many, many things that are different about today, but the thing that really is different is how we think about it, how it's reported, and how much it affects our psyche. And it really does affect us in very, very negative ways. All the way through our life, of course, right? It's in every aspect. But when it comes to the markets, we look at it in the speed of a decline or the speed of the information that comes as to why the market's doing what it's doing can come so fast, it seems disorienting. Like things are different now, so we can't trade the way we did, or we can't hold long-term like we used to. It's really different. And so I really wanted to spend some time talking about this and thinking it through and thinking about exactly where we are, inflation-wise, war-wise, things like that. Because the truth is, we have to admit that there's a whole lot of bad stuff out there. And even Wall Street has been talking about it now. Now remember, Wall Street tends to support Democrats more than Republicans. So their guy got elected. They're really doubting, so this is not political, they're really starting to say out loud, we're kind of concerned because there's no real confidence in what they're doing. There's no leadership confidence. Okay, and I'm not going to turn this into why Joe Biden is a bad president. He isn't polling well within his party. Okay, so that's not the point. The point here is to say confidence overrides how we feel about putting money to work in investments, whether it's in your business, whether it's in the market, other people's businesses, if you will. And when we think about that, of course, we have to then say, well, is it just the political situation? Because for the people on the left, when Trump was elected, it was the end of the world and the market took off. So they don't want to invest because their guy's not in. And so now the right, they're upset because their guy's not in. It's really, we put that weight sometimes on the wrong things. Like Washington, D.C. It's important. It's important to get this right. It's important to have the correct dialogue about companies like Twitter right now. And of course, all the social media companies. They're being attacked from the left and the right all the time. And they should be. Censorship is a huge problem and sounds very much like communism and very much unlike the freedoms we enjoy in our capital markets. So confidence is an important thing and is now being actively talked about. The other thing, of course, that's talked about every second of every day, certainly the last two, is inflation. But certainly that's been being talked about for quite some time. We've talked about it. Our concern is that it's not transient. It's in fact sticky inflation. And we're going to show you a little bit of information regarding that later. But right now, I want to continue with the idea here. I know Jennifer's, I threw her off there getting ready for the inflation chart. I do want to talk about that, but I really want to kind of run down the thought processes and what's going on out there. Not because we can predict the future, because you can't predict the future. And it's so hard for us to not think we're just smarter than everybody else, or smarter than, if you will, the markets in general. I read a lot. I search online. I do all kinds of things. That's deadly. That's not helpful. I get in arguments like I did on Monday morning with people that have been doom and gloom world enders for over 25 years. I know, because I've talked to them on air for 25 years. And they just barf the same stuff all the time. And it's insane. It's really kind of insane when we think about that. We sit there and listen to people who literally have rarely been right. But we quote them. We think about them. We read their stuff. Very unhelpful. But so much is coming at us all the time that this is something we have to sort through, and we do. But the thing that overrides all of this is we need to be humble enough to know we don't know what's going to happen. And so when we think about markets over a long period of time, I love going back and talking about markets over 200 years. Why? Because that's so long. All we're really looking at is a trajectory, and they've gone up 10% a year for 200 years. Since 1926, the S&P, when they started measuring, right before the Great Depression, 10%. Last 40 years, 10%, so on and so forth. Well, should we be buying gold and getting in with inflation? The answer is, why? We all know everything out there. Now, this is something we talk about all the time. Most of you know that my dad, I hired him out of retirement, so he works here. It's awesome. And we love talking about the fact that everything is known. So why do people act like, wow, there's inflation? Yeah. Or, wow, the Federal Reserve is going to raise interest rates. Yeah, they've told us they will. In fact, they promised they will, right? So what do you think markets do? Wait? Or do they react? It would be kind of like, hey, we're pregnant, yay. Let's just see if we actually have a baby, okay? I don't know. Why would we go out and think about what we're going to do? Why would we paint the room pink or blue? Why would we buy a crib? Because at a point coming up, give or take a little period of time, we will have a baby. At some point in the next little bit, interest rates will go up over 2%. Over the next 6 months, 8 months, how's that going to look? Oh, we got to bite our nails and worry about it. Oh, what if they raise 0.5%? What if they raise 1/4? The market expects 2% plus over the next 6 or 8 months. They're reacting. But we have to hear this just played out every day. And that's why I say the noise is so loud. Look, we're not confident in the leadership in this country. We're not confident in the leadership in the world. We're concerned about Ukraine. In fact, it's our heartfelt prayers that the people of Ukraine survive the next day. These are all real worries. Inflation is real, but they're not unknown. And so when we come out and we say inflation is high, how is the market going up today? Because we knew it was high. Actually, defining a number doesn't really matter. I mean, are you going to go, oh my gosh, I came in 0.1% higher? Holy cow, it's disastrous. Number one, they're going to revise it 2 more months anyway. And number two, it's all about the future and where we're going. We forget that often. We really do. I do. We all do. But most importantly, I want to get back to this idea. We can't predict the future. And the markets are forecasting ahead. Right or wrong, they are forecasting ahead. There is no question that interest rates are going higher, right? The Federal Reserve has promised they're going to go ahead and raise it. The market's priced it in. Worrying about that makes no sense. Oh my gosh, but interest rates are going higher. Yeah, they are. So how do stocks do when interest rates go higher? Okay, well, here's some bottom line information for you. We've shared this chart before. I know, Jennifer, you don't have that chart. I'm just speaking off of it. The point of this chart is simple. When interest rates are this low and they go up, stock prices do fine. In fact, they always go higher 100% of the time. That's pretty crazy. You don't find data that's like 100% right. This is when interest rates rise and rates are higher than they are now. That's almost always bad news. Almost always bad news. And the reason why is because we have inflation when rates are high. Everything's distorted. Everything is weird. I've been very frustrated with the Federal Reserve telling us that the inflation that they admit is not transitory. It's in fact real, but we're going to keep digging the hole deeper. This sounds really off the charts stupid. I mean, literally, and nobody ever asks them or holds them accountable. Excuse me, Mr. Powell, but please explain why. If you're now telling us it's not transitory inflation, why do you continue to expand the balance sheet when you think it might be a cause of inflation? Why are you continuing to do that? And why don't we cut rates now or start raising rates now? So this doesn't make sense. So the confidence also, not just politically, all leadership from the Federal Reserve, everything in DC is really, wow, people are concerned all the way around. I don't blame you. I don't blame anybody. We are too. But they are starting to raise rates. They're starting to get out ahead of it, and there is hope. Let's talk about inflation. So let's put that chart up, Jim. There's sticky inflation, there's flexible inflation. And that's the key thing here. So we've got to take a look at this. And I know it looks like a busy chart. It's pretty simple, actually, okay? What we have is everybody's talking about this is just like the 70s. This reminds me of the 70s. It's just like the 70s. And you know what? The policies are so stupid. That reminds me of that too, okay? You can't just print money. They tried it in the 60s and the 70s. It led to an inflationary problem big time. But we're going to try it again and just ask, I can't think of her name, Elizabeth Warren and others, you can just print money until the cows come home. It is not inflationary. Trust us. We already know that that's not true. One of the reasons that Build Back Better failed is because a couple of Democrats didn't buy it either and didn't move forward because it looked like it was an inflationary problem. But what we have to do is define this. Now, what is sticky? What is flexible? Okay, everybody can come up with their own numbers, if you will. But the way the Federal Reserve thinks about it and the way it's reported is that things that change quickly, and there's actually a definition of 4.5 months or less, if they change very, very fast, those are the flexible things. You know, oh, car prices are up 12%. No, now they're down 6%, and so on. That's flexible because they change quickly, okay? But things like medical costs, education expenses, those are more of a year over year. They don't change every day or every month. And that's the way the Fed thinks about it. So the things that are really flexible, and if we look back at the 70s, you can see they kind of moved in tandem. They really did, but they're not now. And as we're looking at oil prices, things like that, gas prices, it affects everything, and we are seeing wages go up. All of those things are all true and could be very inflationary. But right now, sticky inflation is going up, but it has not gone to the levels anywhere near what flexible CPI is or flexible inflation. So there is great hope that we're just going to continue to ride this out and inflation will peak on the flexible side and start to come back down. Whether it's supply chains like Joe blames and all these other things, all of those things are true. They're just not totally true, okay? They're not totally true. We have injected too much money into the system and we're starting if you will, to try to pull that out. It's going to take a long time to see really where we're at. This was a stupid experiment. It went on too long. It is unprecedented. Our money supply is up 40% since pre-pandemic. Now, all these sound like big words economists use and stuff like that. It's not. You understand. The Federal Reserve has injected money. We spent too much. Trump did too. But adding another $2 trillion on top of that for the pandemic was devastating, and inflation took off. And no, it's not Putin's problem. Everybody knows that. Democrats know that. They know it. They're not talking about it. Not in their house races around the country. They're not talking about being Putin's problem. It's been rising dramatically for the last 12 months. This is a problem, but we are now changing directions. There's hope. There's real hope out there. There's no doubt that there's real hope. And what we have to be thinking about, we always talk about this, how markets are never normal, right? They're not normal. Everybody thinks they are, right? Because we are human beings. And so we think in a very linear way. You know, this step, that step, okay? If you think about caveman, right? How do you go kill a bunny rabbit or a deer, right? You follow the tracks. Very linear thinking. It's not like, well, it could be there, and then you run off over here. But that's what markets do. And when we think about that mathematically, we say markets are 10%. That's over a long period of time on average, okay? But this is a chart we add to it every year, of course, and just keep adding, because it was a fascination of mine to be thinking about this in the sense of how do we communicate to people that 10 doesn't mean 10. 10 is a lifelong, very long average return. It is not year to year. And so we started breaking it out and thinking about it like extreme years. What about like greater than 20% down or up, okay? But it also is astounding to me too, when we look at this, that there aren't very many big down years, certainly not compared to the big up years. They're just like seemingly endless numbers of years that are up more than 12%. But there's really only 7 of them that are down more than 12%. It's not even close. So when we tend to be down, we tend to be down a little. And we tend to be up a good bit to make up for those, to get us to the average. But what is astounding really is our brain says 10% and runs this line in our minds that, well, I'm not doing 10% because, well, there could be a number of reasons. Number one, you know, a diversified balanced portfolio doesn't do what the S&P does. It does what the S&P does, plus and minus a lot of other components. But the only thing everybody ever talks about is the market. Okay, but I need income for life and I've got all these other things. Of course you do. It doesn't do that. But still, in our minds, even if we're just talking about the S&P, only 6 years in the last 95, 6, like 6% of the time is the market anywhere near 10%. But our brain says that's what we ought to be doing. And so if it's less than that, we need to worry about it. That's our brain wrecking our investment perspective, sometimes leading us to very wrong decisions in running our money. Let's look at that other chart, Jen, real quick here, because I think it's just important for us to really take a look at some of the basics, and then I just want to try to answer some questions if you have any. Wrong one. Didn't we have another market chart? No?
No,
Right.
That was it, Dave. That's the only 3 you pulled.
Okay.
Which other one were you thinking? I'll find it real quick.
Okay, I was just thinking about the long range chart that showed. I'll just talk it through. It's
right.
fine. Okay, I talked about the 200-year. I've talked about since 1926 what the market does. It's 10%. When we think about the last 20 years, it's 10. The last 33 years, it's 10. It has a gravitational pull, but then we think things change. And that's, again, our brain. And the cancer that's affecting us, if you will, now, is this move to have so much information and we digest it, but we don't. We can't. It's not possible. And we also have this bias in our brain that we accept what we already believe as good and clear and more data. Can you change people's minds? No, you can't. You actually can't. Study after study shows that people are so locked in to their thinking, they will convolute their brains. And this is not new. It's interesting because I'm listening to a book right now called The Bomber Mafia. Okay, it's a very interesting book, by the way. I recommend it. Malcolm Gladwell's new book, and he's in there talking about how this confirmation bias led people, bombers, their generals, their leaders, the flight commanders in charge of all of it, to completely misperceive what was going on in World War II, and even afterwards talk about it as if it was a good success, even if it was like a complete abstract failure. Nobody would think it was good. They literally led themselves to believe that, if you will, the way Nazis do, the way Russians do today, that they're really not doing anything wrong, torturing and killing civilians. Very much like that. And so when we do that, we take that to the markets and we take that into all of our understanding, what we end up doing is just twisting data around and not changing our minds. You literally have to work at it to change your mind. Like, I always believed in value stocks, and then it was like, well, I don't know, I got to kind of rethink this and go with growth too. You know, the world's changing, and I'm glad I did. It would have been a really less successful career, let's just say. We have to make changes and adjust. As I often say, the ground conditions around us now have materially changed. Right now, right in our face, interest rates are being raised fast. The 30-year mortgage moved from below 3 to 5, like that. Fastest move up in history. Things are changing fast. We have to be aware of them and think about them. It's the same reason we look around and we say, can we own bonds yet? No, we still can't own any bonds. We can't. We can't. So we have to have other alternatives in our portfolios because rates are rising so fast. We've got to just get out of the way. Maybe someday we can do that again. But that's the way to think about it. That's the way to think about it in our process, if you will. Can you change your mind? Are you able to change your mind? Because the markets are going to do their 10% over long periods of time, and you can't time it. You can't. We can't. I don't know the future. What I do know is that as we try to think about all the things, if I could only have known, you know, how many people would die of COVID, how quickly it would spread, and blah, 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 how much we'd shut down everything, then I would fill in the blank. No, doesn't work that way. Because many people, if they'd have known that, you would have stepped aside and said, I'm not going to invest in the market. Why would I? And you would have missed a really, really big increase. Knowing what the future is, even if you did, you don't know how people are going to react. And let's face it, you don't, you can't, and the person that you're reading, listening to doesn't either. The amount of misinformation, we're just talking, Jennifer and I were just talking about this morning. How in the world is it that people like a Jim Cramer or whoever else it is on CNBC that you're listening to can stand up there 2-3 years ago when rates were talked about being raised and go, stocks can't go up, not in a rising interest rate environment. And then that is just like parroted all everywhere. And it's 100%. The data shows 100%. That's not true. It's not true. But that's what they all parrot each other. And they're the experts. How is it you're going to handle it? So when we talk about thinking about things long term and so on, yeah, maybe you enter a period after the market does really good. If you're needing income, you be a little bit more cautious. Okay, we did as we entered this year. But what we're thinking about now, we're worried like you. But we're also long-term optimists because it has always worked. The data shows it. And when we think about all the noise out there, that's the important part. Tuning it out, dialing it back. I say it all the time, but I don't know what else to do except remind you and me both that what we're listening to is already in the market. Everybody knows what's coming when it comes to interest rates, right? Or all the things that you're worried about. It's always the things that we don't worry about that get us, right? But markets recover because they're not run by moron politicians. That's why. All right, let's go and take some questions. All right, Jen, I think we covered everything we wanted to, didn't we?
Yeah, I think so.
All right.
As a reminder, you can chat the questions and we'll read them off, or you can raise your hand. Looks like we have one. Dave, do you see it, or you want me to go ahead and read it out?
Let's see. Is it to our advantage at our age to take some of our RMD now? I didn't catch it all.
And now, in order to save some due to the Biden-Russia Central America invasion and interest rate economy.
Okay, if you need the income, fine. That's great. If not, I don't see any reason to rush it out. But for a lot of our clients, we just took it out early in the year, and we do. When markets are at all-time highs, let's take it. And year end, as we all know, and I know some of you called and say, what did you do to our tax bill this year, right? I know, we didn't, okay? The market jumped a lot. And that's why we have so many mutual funds in your non-IRA accounts have had huge distributions. And what we like to do is take those distributions, set them aside, and that at the beginning of the year, we don't reinvest. Rarely do we reinvest them. And that gives us an opportunity to A, to diversify into something else, or B, take care of our required minimum distributions or take care of income needs for the next year. And so a lot of folks, when we say this, you got to understand your circumstance. This doesn't apply to everyone, okay? But generally speaking, we entered this year with a huge cash position for people. Turned out to be wonderful because the market went down and it was at all-time highs. But the reality is from those, if you still have a large cash position, go ahead and take it out, because we're not putting that back to work into this environment, not as quickly as we normally do. It's just we're looking for bargains again. But in this kind of uncertainty for people that need to take money out or like required minimum distributions, we don't want to invest it. We don't want to get back in there and then take it out in 6 months. We don't make guesses like that about what the next 6 months are going to look like. It's one thing to say, hey, I've got another $100,000. What do we want to do with it? And say, well, gosh, the market gave you a nice break here. We can invest that in some great corporations for long term, but not for the next 6 months. Okay. So if it's in there in cash, or give us a call and we'll talk about whether you should take it out right now. Okay.
Yeah. And hey, Dave, we might want to touch real quick too on, don't forget about qualified distributions. If you do any giving at all, it should come from your required minimum distribution. We also can give you a checkbook. So even if you like to do just small donations throughout the year, you can write checks right out of your IRA. As long as you verify cash is available, it's a really nice way to take some tax advantage from that too.
Exactly. No, that's great.
Mike,
that's a super point.
All right. When market is down like it is now, why aren't the experts on TV telling us to buy low, sell high, right?
Good point. Yeah, some are. Okay. That's the funny thing. Again, back to this confirmation bias. What are you hearing, right? I hear this all the time, and I recognize that's because we're hearing, or I am hearing what I want to, or what I already believe. Things are scary. Things are frightening. I'm watching literal bloodshed on TV. I'm watching the prices at the pump. I'm watching the leadership in our country not be able to answer a question. This is all the type of thing that puts into us like, whoa, 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 whoa. I'm really nervous. That's why I talked about that. We forget that Wall Street is very supportive of Democrats, okay? Why are they worried actually talking about their concern with the Democratic leadership? It is everybody. So don't think this is political. I understand nobody wants to get into the politics of this. The point is it puts a damper on our confidence level, okay? So then we start to hear, all the experts. Nope, not all the experts are. A lot of people are calling for S&P 5,000 by the end of the year. That's a nice return from here. A lot of people are talking about this quarter is going to be wonderful, but everybody, and I mean even the bulls out there, are concerned about inflation. But there's a lot of reasons to believe we really are at or near peak inflation, and most importantly, we're at or near it because some of the flexible things, just comparisons, if you will. Does anybody really think we're going to go to $200 a barrel oil? I don't, but I'm just saying that's quite an outlier. Maybe you do feel that way, okay? But we were at 50, so now we're at 100. So we've doubled the price of energy, not including natural gas, which is up huge as well. Is that going to be going forward, or could, if we just stay at 100, which is way high, then you're going to see zero inflation on a lot of those things, okay? So that's the reason why people think it's maybe at a peak, and there's a lot of data to kind of say, let's not quite panic here yet, okay?
All right. Do you advise not to put an RMD back into a brokerage account at this time? So take it from IRA and reinvest.
Oh, no, not at all. Absolutely not. There are so many things that in my mind are already greatly discounted, but it depends on, are we talking about over the next 3 months? That's why I say, are we going to put it in and then take it out in 6 months? Or are we talking about 6 years or 60 years? Because if we're talking about it in a long-term basis, of course, gosh, how often do you get to buy Apple off 20%? Almost never. And nobody does it. They can't wait to dive in when Amazon hits 35 or 3,600 instead of buying in at 2,800. Could have done that earlier. Can't now. It's in between. But you get the point. We want to try to get those things when they're cheap. That doesn't mean they won't get cheaper. They probably will, because the world isn't waiting for you to make your investment to mark the bottom. It's weird, but it's not. I know in my mind, most of the world revolves around me. But I do understand that the market doesn't really think or care if I put money in today, right? And that's the same thing. We have to really temper our thoughts. The other thing is, if you want that money in something that's earning something, then you just let us know. It doesn't, like, why park it in the bank? It doesn't mean it's put in your general portfolio. We have tens of millions of dollars of money today parked in investments that don't move with the market. All we're trying to do is get the 5% yield, okay? So if that's the kind of money you're also saying, I just want to keep this safe for now. But Jen brings up a really good point when it comes to the required distributions. Do all your gifting through it. I just want to throw that out as a reminder. Glad you reminded us of that, Jennifer.
Sure. And also just take a second and touch on corrections and the brevity of them usually, because we just had a comment too that putting it in under the bed is better since they're 73 years young.
Good. All right. Since you all are 73, then my anticipation is you've got about a 30-year life expectancy jointly. One of you will probably make it another 30 years. I think there'll be some inflation in 30 years. Maybe you do too. There certainly has been all of my life. And I'm not just talking today, all of my life, even if it's only 3%. Do we really want to peel off those dollar bills and just watch them go away? Recently, I remember we had an investor, and she has no concept of what's going on, but her husband got dementia, and so she has to take care of everything. And I remember that discussion because it was really something. It's like, well, what about this, and worrying about prices, right? Of course, we all do. And I just said the same thing. I said, we can't just put it in the bank or under your mattress, so to speak, peel off the dollar bills and then hope you die soon enough. Can't do that. We can't do that. That will drive your brain crazy. So what I'm saying is you have an option. No, don't put it under the mattress. If you really have that, just in case, that safe money, then talk to us. I've got this, and I just want you to set it aside. But let's try to earn the inflation rate on it. Don't just put it in the market, because a lot of people perceive that we're either in cash or cash-like, right, and earning nothing, or then we're in risky stuff. Thanks, Jen. That's great. This is just one of the things we use, and it doesn't matter what it's called or what it is. I'm just telling you, it's real estate, or it doesn't matter. You're not going to find this name anyway. You can't buy it outside of here. So the point I'm trying to make is I don't want to dive into the whole makeup of what this product is. What I want you to understand is just what's called a heat map, how volatile it is, how day-to-day trading, right? And it's a mutual fund. It's a mutual fund of real estate. And it's different because it's private real estate, not publicly traded real estate. And so as we look at that, the green, as you can see here, interestingly enough, and most of you have some of this or like this in your portfolio. But if we look at the bottom there, Jen, can you point to 122 and 222? Just down here for people. That's since the beginning of this year, every single trading day for January and February, okay? The market got clocked in January and February, right? I mean, we all know that. There's not one day that's traded down. That's what I'm saying. There's also other alternatives. They don't perform. They're not going to go up like the market has, but that's the safe money. And in an inflationary environment, you don't want a lot of cash earning a negative 8% in today's inflation world. That makes no sense to say, oh, wow, I feel great about it because over the next couple of years, I'm only going to lose 15% of my money. That's not a plan. That's just operating in abstract fear. Frankly, just doesn't make any sense. Why? It'd be like running around screaming and yelling and not finding the exit to the burning building. It just, because you're in fear, it doesn't mean this is the way to react. So we do want to impress that there are alternatives out there. And for that quote, I don't think I'll ever need this, but I've always kept 50,000 pretty safe type of thought. Okay. Anything else, Jen? You are muted.
Sorry about that. I didn't want to be making noise when you're talking. So cute comment. Yes, we do think you could potentially make it to 103. We have a lot of clients. I actually spoke to one yesterday that's pushing 100 and he's doing great. So as technology increases, yeah, easily 103.
We had a 100-year-old that gentleman, great guy. He's still around. And he turned 100 years ago. He must be 105, 6. And that's so yesterday. Without today's modern medicine and where people are going, we have to plan for that. So very good point.
All right. Anyone else? Any questions? Raise hand, another text. All right. Well, we're going to continue to do these more frequently because I do think it's important to continue to touch base, but always call us as well. And we'd love to touch base one-on-one. Diana, if you want to chat, please call us right after this and we can go into a little bit more specifics on your account, okay?
Exactly. Okay. And again, I just want to reiterate to everybody out there, we appreciate you. And if there are some things out there that you all want to talk about, would suggest we talk about, let us know. We'd really like to, possibly address that in an upcoming Zoom. So help us help you, okay? Everybody take care. Thanks for joining us.